You have $100, not every month, every week. The kind of money that can disappear without you even realizing where it went. Dinner, a few deliveries, a new pair of shoes, a random Amazon order. By next Friday, you barely remember spending it. But what happens if that same $100 stops disappearing and starts working? Not once, not when the market looks perfect, not when you finally get a raise. Every single week. $100, 52 times a year. At first, it looks almost pointless. Then something strange happens. The money you invested starts making money of its own. And eventually, your money starts adding more to the account than you do. So let's see what actually happens if you invest $100 every week and refuse to stop. Week 1 Friday comes. $100 leaves your checking account. You invest it. Your portfolio now says $100. That's it. There is no celebration, no financial freedom, no dramatic chart, no feeling that your life has changed. Monday comes. The market drops. Your $100 becomes $98. Great, you finally started investing and somehow you already lost $2. You check it again Tuesday. $99. Wednesday, $97. And for the first time, you understand why investing feels completely different when the money is actually yours. Watching a chart on YouTube is easy. Watching your own money turn red is different. But Friday comes again. Another $100 goes in. Now you have almost $200 invested. Then another Friday, another $100, and another. There is nothing exciting about it. That is exactly why it works. Because the first stage of building wealth usually does not look like wealth. It looks like repetition. The first 6 months, you have now invested $100 every week for roughly 6 months. 26 deposits. Your own money contributed $2,600. Using our 8% illustration, the account is around $2,650. Your investment growth, about $50. 6 months of discipline for $50. This is where the first test happens. Because $2,650 does not feel rich. It doesn't change where you live. It doesn't buy financial freedom. It probably doesn't even feel dramatically different from the $2,600 you personally put in. And your brain starts doing something dangerous. It starts asking, is this even worth it? That question destroys more wealth than most people realize. Because people want the result before the process has had enough time to produce it. 6 months feels long to you. To compounding, 6 months is almost nothing. Right now you are doing nearly all the work. Your deposits are carrying the account. The investment returns are barely helping, and that can feel disappointing. But think about what actually changed. For 26 straight weeks, you proved that $100 could leave your account, and life continued. Your rent still got paid. You still ate. You still had a life. That $100 that once felt impossible to spare slowly became normal. And normal is powerful, because once something becomes normal, you stop needing motivation to do it. Year 1 year, 52 weeks, you personally invested $5,200. At our hypothetical 8% return, the account is around $1,400. Roughly $200 came from growth, not exactly a Lamborghini. And this is why year 1 is where a lot of people misunderstand investing. They expected money to start multiplying. Instead, it mostly looks like their own deposits stacked together. $100, $100, $100, again and again. But the biggest thing you gained this year isn't the extra $200. It's that investing is no longer something you're planning to start. You started. There is a huge difference between those two people. One person has spent 12 months watching investing videos. The other person has spent 12 months actually owning investments. One has information, the other has a system. And systems can keep running when motivation disappears. Years 2 and 3 now, things begin to feel different. You're 3 years in. 156 weekly deposits. You personally contributed $15,600. Your modeled account balance is now around $17,600. For the first time, there is a noticeable gap. About $2,000 exists that you never directly deposited. That money came from the growth of the money already inside the account. And this is where something changes psychologically. At the beginning, investing felt like money leaving you. Now it starts feeling like money building something for you. But then the market falls. And this matters because every investing journey sounds easy when the chart is moving up. The real test comes when it moves the other direction. Imagine your account reaches $17,000. and then the market falls hard. You open the app. 16,400, then 15,900, then lower. Months of gains disappear. Your brain immediately gives you two ideas. The first, stop investing until things calm down. The second, sell before it gets worse. Both feel intelligent in the moment. Because fear rarely introduces itself as fear. It usually sounds like logic. But instead, Friday arrives. Your automatic $100 still goes in. The market is cheaper now. That same $100 buys more shares than it did when prices were higher. Next Friday, another $100. You don't know where the bottom is. Nobody does. You're not trying to predict it. You are simply following the system. Regular equal investing through market ups and downs is the basic idea behind dollar cost averaging. And months later, when markets recover, you understand something that no motivational quote could have taught you. The bad months were not wasted months. You were still accumulating. Year 5 years. 260 Fridays. You personally invested $26,000. Modeled balance about $31,900. Almost $6,000 more than you deposited. Now the numbers have enough weight that you notice them. But here's what's interesting. 5 years ago, investing $100 felt like an event. Now you barely think about it. The transfer happens. The investment happens. You continue living. The behavior that once required discipline has become part of your financial life. And this matters more than people think. Because the goal isn't to spend 40 years fighting yourself every Friday. The goal is to build a system strong enough that the decision eventually stops feeling like a decision. This is also around the point where you start seeing money differently. A $400 purchase doesn't only look like $400 anymore. Part of your brain says that is 4 weeks of investing. A $1,000 impulse purchase, 10 weeks. You're not becoming cheap. You're becoming aware of trade-offs. There is a difference. You can still enjoy money. You can still travel. You can still buy things you care about. But now, every dollar has competition. Spend it today or give it decades to become something larger. That question did not exist in your mind 5 years ago. Now it does. Year 10 years. You personally invested $52,000, $100 at a time. Modeled account value, about $79,600. That's approximately $27,600 of growth. Now stop here, because this is where the story begins changing. In the beginning, almost everything in the account came from you. Now more than $27,000 came from modeled investment growth. You didn't work overtime for that specific $27,600. You didn't start another job for it. You didn't make another 276 weekly $100 contributions for it. Your existing money had time to compound. And compound growth means returns can begin earning returns of their own. This is why the first 10 years can feel so unfair. You do all this work, and the numbers still look relatively normal. But the first 10 years are building the base that the next 10 years get to compound on. People want the exciting part of compounding, but the exciting part requires a boring part first. There is no giant snowball without the tiny snowball at the beginning. Now something else changes. You've been doing this for 10 years, but your account is not the only thing that changed. You changed. You have lived through good markets, bad markets, headlines predicting disaster, people telling you stocks were too expensive, people telling you everything was about to crash, people telling you this time was different. And somewhere along the way, you stopped needing every week to feel safe. You realized one red month does not define 30 years. You also stopped waiting for the perfect time. Because after 10 years, you've seen something important. There was always a reason to wait. Always an election, inflation, interest rates, a recession fear, a war, a banking scare, a market correction, a record high. There was never a giant green sign that said, "Congratulations, today is the perfect day to invest." You simply kept going. And that consistency became an advantage. Not because it removed risk. It didn't. Investing still involves risk, but because your plan no longer depended on predicting tomorrow. Year 20 years. Let's look at the numbers. Your total contributions, $104,000. That's real money. You put it there, week after week. But your model portfolio at 8% is now around $256,500. You deposited $104,000. The modeled account has roughly $152,500 beyond your contributions. Read that again. Your modeled growth is now larger than every dollar you personally put in. This is the crossover most people never stay around long enough to see. At the beginning, you were carrying the portfolio. Now the portfolio is helping carry itself. 20 years ago, 1 week's investment was $100, and $100 felt meaningful. Now your account can move thousands of dollars in a normal market swing, sometimes up, sometimes down. A 1% change on $256,000 is roughly $2,560. Your original weekly deposit was $100. The machine has become larger than the shovel you used to build it. And here's the crazy part. You did not need to become a genius. You did not need to discover the next Amazon. You did not need to trade every morning. You needed money, time, consistency, and an investment approach appropriate for your goals and risk tolerance. Diversification can help spread investment risk, though it cannot eliminate market losses. The part most people don't realize most people here invest $100 every week, and they calculate $200 a year. Then they think, okay, 20 years is $104,000. Correct, but that's only the money you contribute. That calculation ignores what potentially happens inside the account. That's why compounding looks unimpressive early and almost unbelievable late. At year 1, the difference between your contributions and the modeled balance is only about $200. Year 5, about $6,000. Year 10, about $27,600. Year 20, about $152,500. The amount you invest did not change, still $100. The thing that changed was the amount of money that had time to work. Year 30, 30 years, 1,560 weekly contributions. Total money you personally invested, $156,000. Modeled balance, approximately $650,000. Your contributions, $156,000. Modeled growth, about $494,000. You put in less than 1/4 of the final modeled balance. The rest came from the compounding in this illustration. And this is where the person who started 30 years ago looks completely different from the person who kept saying, I'll start when I can afford more. Because maybe the other person eventually could afford more. Maybe they started with $500 a week later. Maybe $1,000. But money can replace money. Money cannot replace time. The early contributions had something later contributions will never have. Decades. Your first $100 had 30 years to move through market cycles, to earn returns, to potentially earn returns on those returns. Your 1,000th $100 did not. That is why starting small can matter more than waiting to start big. But what if you miss a week? This is where I want to make this realistic. Life happens. There may be a week where $100 is not available. Maybe the car breaks. Maybe a medical bill appears. Maybe your income drops. Maybe you have higher interest debt that needs attention first. The lesson is not invest $100 no matter what happens. That would be irresponsible. An emergency fund and expensive debt can change what makes sense for your situation. The lesson is don't let one interruption become the end of the identity. Miss a week? Fine. Fix the problem. Restart. The danger is not one missed contribution. The danger is turning, not this week into, maybe next month. Then when things settle down. Then next year. Then one day you realize 10 years passed while you were waiting for life to become convenient. Life does not become convenient. Your system has to survive real life. Year 40 now, we reach the number that sounds fake until you understand how much time has passed. 40 years, 2,080 weeks. You personally contributed $208,000. That's the amount that actually came out of your pocket. Using the same hypothetical 8% return, the modeled account is approximately $1.53 million. Your deposits, $208,000. The difference, more than $1.3 million. Again, this is a mathematical illustration, not a guaranteed outcome. Real markets do not return exactly 8% every year. Some years can be much higher. Some can be negative. Fees, taxes, investment choices, and actual returns all matter. But the lesson is not that $100 a week magically guarantees $1.5 million. The lesson is what time can potentially do to a consistent investment habit. At the beginning, you were putting $100 into an account worth $100. 40 years later, that same $100 contribution would be almost invisible beside a 7-figure portfolio. The contribution did not become less important. It became the thing that built the base. $100 never changed. This is the strange part. The weekly number was never impressive. $100. People spend it without thinking. $100 doesn't sound like wealth. It doesn't sound like retirement money. It doesn't sound like a millionaire strategy. And that is exactly why most people underestimate it. They assume small money creates small results. But small money, given enough repetition and enough time, does not stay small. The contribution stays $100. The base gets bigger. Then the potential growth happens on a bigger base. Then that growth has the opportunity to compound too. The amount stays ordinary. The timeline makes it extraordinary. What you actually built, and here's what I think matters even more than the final number. After 40 years, you did not only build an investment account, you built proof that you could tell yourself, I'll do this every week, and actually do it. Proof that market fear didn't control every decision. Proof that you didn't need the perfect salary to begin. Proof that your financial future could be built through thousands of boring decisions nobody else saw. Because wealth rarely arrives with background music. Most weeks, nothing happens. The transfer goes through, the market opens, the market closes. You go to work, you come home, another Friday comes, another $100. Nobody congratulates you, nobody knows. There is no viral moment, but the weeks stack. Then the years stack, and eventually the numbers begin telling the story for you. The real difference there are two versions of the same person. Both want to invest. Both know investing matters. Both believe they'll do it eventually. Person number one starts with $100 this Friday. Person number two says, $100 isn't enough. I'll wait until I can invest more. 5 years pass. Person one has a system. Person two still has a plan. 10 years pass. Person one has roughly $80,000 in our illustration. Person two finally has a bigger paycheck, but they also have a bigger apartment, a bigger car payment, more subscriptions, more responsibilities, and somehow starting still feels difficult because waiting didn't build the habit, it trained the habit of waiting. That's what most people don't realize. Starting small is not only about what the first $100 earns, it's about what the first $100 turns you into. Someone who invests. Final so what happens if you invest $100 every week? After 1 year, you have roughly $5,400 in our example. After 5 years, about $31,900. After 10, almost $80,000. After 20, about $256,000. After 30, around $650,000. And after 40 years, the same mathematical illustration lands around $1.5 million. But don't leave this video thinking the lesson is $100 equals $1.5 million. That's not the lesson. Returns aren't guaranteed. Markets don't move in straight lines. And your actual result could be higher or lower. The lesson is simpler. You don't need your first contribution to be impressive. You need it to exist. Because everyone wants the portfolio at year 40. Very few people respect the $100 at week 1. But you cannot have one without the other. So don't wait for the giant paycheck. Don't wait until investing feels easy. Don't wait until you know everything. Learn what you're investing in. Choose an approach that makes sense for your goals and risk. And if $100 a week works for your finances, start the machine. Then give it the one thing money cannot buy back later. Time, $100 every week. And then leave the future enough time to surprise you.